us this morning for this briefing on our latest quarterly economic outlook. My name is Fergal O'Brien. I'm Director of Lobbying and Influence here in Ibec. So I'll be chairing this morning's discussion. Shortly, I'm going to ask our Chief Economist, Brady, and our Economist, Hazel Ahern-Flynn, to join us to take us through, I suppose, the latest highlights from the economic outlook, and then we'll have lots of time for Q&A. So I would encourage people to use the chat bar throughout the session, as Ger and Hazel will be talking to the slides and any of the data that you have any kind of observations or questions on, or anything else you want to post to us. Please do pop it all into the chat, and we'll have lots of time to go through that towards the end of the session. I suppose when we were kind of muddling our way through COVID in 2021, we had hoped that spring of 2022 would be one of buoyancy, optimism, and real dynamism in the economy. Clearly, a lot has happened since the start of this year. Inflation is now the topic du jour for all of us. It is going to have a significant impact on all aspects of the economy and business. Clearly, it's going to impact on consumer spending. It's going to impact on business costs, and we're seeing that come through in a significant way. So even since the start of this year, obviously, both business and consumer sentiment has been impacted quite significantly by those rapidly changing external events. But of course, what we're seeing come through now in that supply chain disruption, in these worrying cost increases and the inflationary pressures, and all of that happening in what has been a very tight labour market. In a way, none of that is new. So the war in Ukraine has definitely added to those pressures, but in many ways, the origins, in particular, of the inflationary pressures have been there for some time. You could even go back to the last financial crisis, but particularly to the COVID crisis and to the scale and pace of the increase in money supply that happened through COVID. That was inevitably going to bring some inflationary pressures into the economy, and the war in Ukraine, the dreadful war in Ukraine, is very much added to that now. So we're seeing, I suppose, for many of us in our working lives, almost the first period of a real significant inflationary phase in the economy. So that's going to bring a lot of challenge. Right now, from an Irish perspective, we're not facing particular competitiveness pressures. There's a sense of kind of most countries are in this together. I think it's what we do next is really going to matter. How we respond from a policy perspective, from a wage trends perspective, to these inflationary pressures is really going to dictate how we come out of this from a competitiveness viewpoint. So this next phase domestically, while the origins of all of these challenges are predominantly international and external, this next phase domestically is going to be really important. So you'll see in the numbers now as we chat through them, obviously we are paring back our economic growth forecasts, reflecting these pressures coming through, particularly the inflationary pressures, what that's going to mean for interest rate policy as well, and interest rate trends, which will also have an impact on the economy. But again, Ireland is coming into this next crisis, and it does seem like, I know for all of us, perpetual crisis at this stage, but we're coming to this next crisis phase from a real position of strength. So we had incredible momentum again, getting out of some of the kind of COVID challenges from last year. Incredible momentum coming into the economy this year. The economy really on all fronts was going really strongly, but also we have a very significant buffer. Again, that we'll see in some of the data in terms of the savings that have been built up during COVID. So I think Ireland is probably in a better place than most economies to weather this challenge of the inflationary crisis, but clearly it is going to have an impact on us. So look, as I said, lots of time for questions, so please do put them into the chat bar as we go. We're also recording this briefing, and we'll make it available afterwards. So in the first case, I'm going to invite our Chief Economist and Head of Policy, Brady, to come on to take us through some of the slide deck, and he's going to be joined shortly then by Hazel Ahern-Flynn. Thanks, Ger.
Thanks, Fergal, and hello, everyone. I'm going to take you through, I suppose, the first part of this presentation, mostly about the kind of macroeconomic picture and the big economy-wide picture, and then Hazel, as Fergal said, is going to join us in a few minutes and take us through the labour market and some of the challenges, and particularly at that level in the economy. So look, a huge amount, as Fergal has said, has changed since we last did an economic outlook in December. If you look at where we were last December, we had three things going on in the economy. Firstly, the reopening was happening, and we were beginning to see the signs of and early signs of a real consumer recovery. But secondly, in the global economy, we had blocked up supply chains, so there was a lot in surveys of Irish manufacturers, of Irish producers, huge challenges in global supply chains already emerging and already there. We also had rising energy costs because Europe had underprovided for gas in particular in 2020 and 2021. Stocks were low, prices were starting to build up. But what we really did think was that there was going to be a really strong consumer recovery this year off the back of two pretty difficult years due to COVID. What we have seen in the meantime, two things have happened. One is the obvious Russian invasion of Ukraine and everything economically. Look, there are huge humanitarian issues as well, but economically here, there are enormous changes that have flowed from that. And secondly, we've seen a re-outbreak of COVID, particularly in West Asia and particularly in Shanghai, that have again blocked up global supply chains. So what does it all mean? If you look at natural gas prices now in the futures curve, so this is looking at pence per term, how much the market expects to be paying for gas, wholesale gas prices, out into the middle of next year. And the reality is, in a normal year, you'd be paying somewhere between 40 and 60 pence per term. And at the moment, it's looking over 200 pence per term all the way through into the middle of next year, and only coming back down during the summer of next year in the futures market. Secondly, on commodity prices, because mainly linked to the Russian invasion of Ukraine, we've seen record jumps in commodity prices. So this shows energy, food, fertilizers, metals and minerals, and precious metals all the way back to 2015. And you can see across most of those indices, there's been a massive spike. In the late part of last year, there was already pressure in the market, but there's been really sharp spikes through into February and March of this year. And that's continued into April. And then thirdly, the high transport costs. So the cost to bring the 40-foot refrigerated container from East Asia to Northern Europe was before COVID about $2,000. And to bring that same non-refrigerated container to Europe now is about $14,000, or was $14,000 up until about Christmas, is now back down around $12,000. So across gas prices, they're at record levels. Commodity prices are at record levels. And we also see transport costs in the global economy at record levels. And because of that, inflation has been high. Some of that has passed through into the domestic economy for consumers and for households. The second element of it, which is going to be a challenge from our perspective, is that it's unlikely that even if that inflation starts to ease off in the coming years, it's unlikely that the cost levels are going to come down as quickly as the rate of inflation might come down. So you might see normal rates of inflation return to 3% or 4% inflation, or even 2% inflation in the coming years, from 2023 or 2024 onwards. But it's unlikely that you'll see a reduction in the price level, at least for another 18 months or 24 months. So there's going to be continued price level pressure, which will be built into costs in the economy. And that's the big danger here. And there's a greater danger then if we start to respond to it in a way which, from fiscal policy and labour market policy, and even within our own workplaces, if we respond to it in a way that builds in costs, it's going to be very difficult to adjust those costs back down. On the positive side, look at, as Fergal said, there was huge momentum in the economy, and you can see it for two reasons. On the right hand side, you can see in the sectors worst impacted, in accommodation and food, the sectors worst impacted by COVID. You can see January and February credit and debit card spending in those sectors was at record levels in 2022, having been and well above 2020 levels. having been decimated in 2021. So you could see that momentum coming back. We also saw it in other indicators in retail sales. In the labour market, we're over 2.5 million people in employment now, a record in the history of the state. So there was huge momentum in the economy. And if anything, from an employer perspective, there was almost too much momentum in the economy in terms of not being able to find workers, not having spare capacity, and the increased pressures that brought. And we expect that to follow through into 2022 because the household savings stocks that Irish households had were so high. So you can see in the chart on the left-hand side from 2017 to 2020, we saw a fairly linear path of household savings rising because the economy was getting better. And then where the line turns from pink into blue, you can see the impact of COVID. Because people weren't able to spend, they built up almost 22 billion euro of savings above where you would have expected had that pre-COVID trend just continued onwards. So before Christmas, we were saying that money is going to start to come back into the domestic economy, and people are going to slow down their rate of saving as well, which will really give a boost to the consumer economy. But there's three main reasons where that effect is going to be much weaker now than we would have thought pre-Christmas. Firstly, the level of inflation is going to erode the value of some of those savings. Secondly, because the environment economically in general is just so much more uncertain, people will hold back on spending, on discretionary spending in particular. And thirdly, we have more of those savings are going to be spent on dealing with some of the energy costs, some of the unexpected bills that people have, and they'll provide a buffer against those costs. But the European Central Bank have done some work just in the last week, which shows particularly for lower income households, when they get into unexpected costs, they tend to eat into their savings very quickly and stop saving. They have to put everything towards the immediate. And that means that while consumption we expect might hold up this year, consumption outside the areas where you're seeing strong inflation, so there'll be the same turnover across all of Irish business, but where that turnover is going to be more heavily weighted towards energy costs in particular and other costs. So what is that called, and what does it look like for an economy-wide impact? These are our forecasts in Q4 versus our newest forecasts. And what we're seeing in the economy is something called a relative price shock. So in non-technical terms, what that means is that because people are spending more on their energy costs, more on their grocery bills, and more in other areas where you're seeing high inflation, they're going to spend less or cut back in other areas. And we already have seen some of that. For those of you who may have seen the Bank of Ireland Economic Pulse yesterday, their kind of surveys of consumers and the KBC Consumer Sentiment Index have both shown people starting to think about holding back and saving more, or saving less and spending it on dealing with the inflationary pressures that they see. So that leaves less, particularly for discretionary spending, and a particularly large impact on the sectors, unfortunately, who were worst hit by COVID, because particularly our experienced economy, a lot of the spending is discretionary, and that discretionary spending is likely to be hit because it's the first area that people can cut back when they're dealing with all these unexpected bills. What kind of scale is it at? Well, the energy bills, people's fuel, people's transport costs from fuel, heating bills, electricity, and all those kind of energy costs make up just under 10%, about 9% of Irish household budgets. So every time you see the costs of energy and the costs of fuel for households go up by 10%, you're probably cutting about 1% off the amount that households are spending elsewhere in the economy, or you're seeing, unless that is replaced effectively by higher wages or by government supports or something else. So there is going to be a pretty significant impact. We think consumer spending is going to be lower in the range of about 2 percentage points than we had expected, but still fairly robust at 6%. On the business side, we're seeing it across lots of members who are seeing energy bills 3 to 5 times higher than they were in 2021 and years previous, where they had been fairly steady over recent years. That those energy bills are a multiple of what they were, 3 to 5 times what they were, and those costs then are eating into the available resources, firstly for investment. Secondly, they're eating into people's confidence about whether they should be investing or not, because the economy is experiencing such a period of uncertainty. And thirdly, they're making people reevaluate whether investments stack up and the type of investment they were doing, and also whether they're investing in the right areas, because obviously much higher energy prices creates a very different investment dynamic in terms of those kind of hurdle rates, and whether investments make sense, and whether different investments make sense. So we expect that to slow business investment quite a bit in 2022, particularly in the manufacturing and industrial sector, and also in construction, which Hazel will talk a little bit about in a while. On the rest of the economy, on the export side, the Irish exporting sector will be impacted because of the global slowdown, but we're still seeing very, very strong trends at a sectoral level. And then overall, we expect the turnaround, I suppose, in our forecasts. We expected 6% GDP growth and 3% inflation roughly before Christmas. We now expect 4% GDP growth and 6.5% inflation for the full year of 2022. And all of this means it's a pretty delicate balancing act for policy. So we're going to see, or are likely to see, interest rate hikes by the European Central Bank. We've already seen government bond yields start to return to 2014 levels now. They're up at about 1.6% this morning, because the European Central Bank is stopping buying Irish government bonds, which makes it more difficult for the government to engage in fiscal policy like they did with COVID. The other challenge from a fiscal policy point of view is that because higher interest rates faced on government debt, and because you have high inflation in the economy, if you do too much on fiscal policy, too much spending, too much government supports, you actually risk making the inflationary environment worse, because the supply and energy costs are not going to react, so it creates a bidding up effect. So the more the government does, if it tips over a tipping point, the harder actually it will be, and the higher inflation will be. So it's a big pressure on fiscal policy and monetary policy. As I said, we're going to see interest rates rise pretty significantly, and where we see the role of the government and the place that they can play, because they don't have control of monetary policy, they have limited use, or it could be actually a negative effect if they did too much on fiscal policy. The labour market and the workplace is where the government can have a positive effect, and the work between unions, employers, and the government at the Labour Employer Economic Forum, which Ibec leads from the employer side on, is going to be significantly important, and particularly in an environment where we have high inflation, where we have a really tight labour market still, and where, as you can see on the right-hand side, a lot of increased costs coming down the line for business, and costs that have come in an uncoordinated way. So we need, and are calling on the government yesterday when we launched our outlook, to have a much more coordinated, joined up view with unions, with employers and themselves, to make sure that the tax, social welfare, and these labour market and workplace proposals don't add to inflationary pressures and lead to worse economic outcomes in the long term, which we've seen before in this country, where you start chasing inflation and we get into a very dramatic adjustment and negative adjustment in a couple of years' time, as we saw in the 1980s and the 2000s. So look, that's the kind of macro view. And we've said, look, it's a difficult balancing act for the year, and effectively it is. I'll hand over to Hazel now, who's going to talk a little bit about that labour market dynamic, where we see things going for the rest of the year, and also some of those construction issues that we've seen in the housing market as well. Thanks very much.
Hi, thanks, Ger. Yeah, so as Ger mentioned, I'll maybe just start by looking at the labour market, which, aside from those inflation and supply chain issues, would be another one of those fairly pressing issues in terms of capacity in the Irish economy. So at the moment, it's something of a mixed blessing in the story so far, in that what we would have seen up to late last year in the last quarter was a stronger than expected recovery in terms of employment, and a faster than expected recovery. So I suppose this year, what we've seen is that we've consolidated on that jobs growth, and that's to the point where we're now at over 2.5 million people at work for the first time in the history of the state. So it's an indication of just how quick and how strong that recovery has been in terms of jobs. At the same time, that strong employment recovery also means that businesses are now facing into a very tight labour market, and that brings its own difficulties in terms of recruitment and retention. In terms of the employment picture, so the pandemic unemployment payment scheme was wound down in early March, and then the remaining people on that payment have now been moved on to job seekers or the other relevant payment. Where that leaves us is with about 146,000 people unemployed, and then an unemployment rate of about 5.5%. So that's not that much higher than where we would have been just before the pandemic, and we'd expect that to keep tapering off over the rest of this year and into next year. So what this chart is showing is just a breakdown of where we are now in terms of employment in each sector versus where we would have been at the end of 2019, just before the pandemic. So it's the growth rates in employment per sector. So the good news here is essentially just that the majority of sectors are closer to, or they're now above the total number of people working in those areas that they would have seen before the pandemic. The main exceptions that we are seeing there is just in administration and hospitality and in personal services like hairdressing. And that's what you'd expect given the nature of the pandemic restrictions up to the end of last year. When we get the official count of employment by sector for the last couple of months, we're very likely to have seen some big improvements in those areas as well, given the dropping of most of the restrictions that impacted those sectors in January. Yeah, on the other side, in terms of the labour force, coming out of COVID, we've seen an awful lot of disruption, and the impact that's having, it's essentially changing the composition of our labour force. So over the last 2 years, we've seen a 6% increase in total numbers working or looking for work. And when you dig down into that a little bit, proportionately, a lot of that increase is coming from higher numbers of 15 to 19-year-olds in the labour force, both because we have a younger population that are now entering into working age, and then also because a higher share of working age teens overall are entering the labour market. On the other side, we're also seeing more people in the kind of 45-year plus age range also entering the labour force as well. So we're seeing changes from both sides in terms of the age composition. We're also seeing more of a gender balance coming through. So more men and women collectively have entered the labour force as a whole, but proportionately we've seen a larger increase in women in the workforce. There's a couple of possible reasons for that. So firstly, among that younger age group that are now entering into working age, there's just demographically likely to be more of an even split between genders. And then other factors might also be changes in hours and the jobs composition brought about by the pandemic, combined with rising wages and then also more active recruitment on the part of businesses. All of that together might be pulling more women into the workforce. Where that's left us is broadly with a higher percentage of female labour force participation rates. So that's the share of women of working age who are either in employment or seeking employment. So that's now up to 60%, up from about 56% before the pandemic. So it's a welcome change that maybe we wouldn't have anticipated. Overall, in terms of what's happening in terms of unemployment and the labour market as a whole, we're not seeing any sign of a great resignation that maybe the media would have been discussing internationally a lot over the last couple of months. We're not really seeing any indications of that in the Irish labour market, and that would be where people would be leaving employment. But what we are seeing is a big uptick in terms of recruitment activity, in terms of new entrants into the labour market, taking up jobs, and then we're also seeing more people switching jobs on the back of all those pandemic disruptions. So in terms of the outlook for the future in the labour market, what we're expecting is average unemployment for this year to average at about 5% for the year as a whole, and then next year to fall down to about 4.5%. And that would take us to below what we would have considered full employment just prior to the pandemic. So we'd then be into quite strong growth territory in terms of jobs post-COVID or post the restrictions at least. The last piece on the labour market is just that, as I mentioned, the counterpoint to that good news in terms of a faster than expected recovery in employment are the difficulties in recruitment and retention that businesses are seeing at the moment. So one of the high frequency indicators that we'd look at is job posting data on Indeed.ie, which is what you can see here. So this is a breakdown of both new jobs postings and then total postings on Indeed per week. And they're both well above their pre-pandemic levels. So this is a percentage change compared to where they would have been in February in 2019. So it gives you the improvement over the baseline again just before the pandemic. So the total jobs posting is a fairly good indicator of just how tight the labour market is at the moment, because it reflects both the number of new open positions that are being advertised, but then also the fact that those roles are staying unfilled for longer. So what we've seen so far is that new job postings peaked at about 70% above their normal pre-pandemic level in February. They've tapered back down a little bit, but they're still at a very elevated level compared to what we would have seen normal hiring activity before the pandemic. On the other side of that, we also look at vacancy rates, and that's the percentage of total roles in a sector that are being advertised for but are currently unfilled. And those have also been creeping up across most areas. So in particular, the sectors that were still growing over the pandemic and saw less disruptions in terms of employment, and that's the areas like ICT and finance and professional skills, they would all have vacancy rates at the moment of around 2 to 3%. Which is historically quite high. And then construction has also seen a fairly sharp increase in unfilled roles in the last couple of months. And that, again, that would be another sign of how the overall level of available supply of labour in the market is becoming especially tight, given it's usually comparatively easier to source labour for the construction sector rather than some of the more niche skills that you might see in some of those other sectors. So with the kind of growth that we're seeing at the moment, combined with a lot of businesses reporting difficulties sourcing labour, what we expect is that attracting inward migration from outside the EU is going to be increasingly an important part of Ireland's future labour supply over the next couple of years. So with that in mind, we've also taken a look at work permits granted over the last couple of years. And essentially the outcome of that is that there's been no significant increase in work permits granted this year and over the pandemic versus 2019. So we're at about 16,400 work permits granted across Ireland. At the same time, we're seeing demand for those permits spiking over the last year, and it seems that the processing system is struggling to keep up. So we have seen some improvements in terms of speeding up of decisions around granting of those permits, fast tracking for certain key skills to get them into the labour market, and again, directing more resources towards processing applications. So the hope is that that work permit approval side will pick up over the coming year. In terms of the sectoral impact of where that labour is coming from internationally, the vast majority of those permits that are granted would be concentrated in the ICT and healthcare sectors, and those are two sectors that historically would have needed to recruit quite heavily from abroad to meet their skills needs. But again, it's just another indication of, one, how tight the labour market is, and two, how pressing the demand for certain skills is in certain areas. So the last piece is focusing in a bit more detail on the construction sector and in housing, and those areas that have seen an awful lot of disruption and challenges over the last couple of years on the back of the pandemic. So the construction sector, like the majority of sectors, is experiencing quite strong labour pressures along with everyone else. And that comes with its own difficulties in terms of recruiting enough labour to meet the really high bounce back in demand that construction is seeing at the moment. And that's after the last couple of years where certain projects would have been delayed, or decisions around them would have been deferred, or over the various lockdowns we saw sites closing. So at the moment we're seeing a very strong and a very quick bounce back in construction demands from all areas. At the same time, construction is seeing very sharp inflation in building materials costs, and that's along with ongoing shortages and longer delivery timelines from those global supply chain disruptions. A lot of key building inputs have increased by about a fifth or more over the last year, and then you have certain key materials like timber and steel that are more than 50% as expensive now as they would have been this time last year. So there are some really strong cost pressures coming through on the construction side. And all of that together is really frustrating progress in the sector, and increases in costs in both commercial and residential projects. And we're starting to see that come through in terms of the delivery and completions. An additional challenge for the construction sector is also that ongoing energy crisis that Ger was discussing. So that's largely because energy makes up a significant share of construction costs overall. So in particular, the construction sector is feeling the impact of those cost pressures at the same time. So as a sector, it's kind of facing challenges on all sides at the moment. And then when you combine those issues around sourcing labour and around cost increases, along with the unpredictability of future material and energy costs, what we're also starting to see is that tender prices are increasing, and that's on the back of firms being less able to commit to fixed price and longer timeline contracts in a very volatile environment. So as a result of all those capacity constraints in the construction sector, some projects are being deferred or being delayed, despite the fact that demand for construction from households and from businesses and from the state itself are all continuing very strongly. So I think the last piece we'll look at today is just in terms of what that means for housing delivery. So Ireland is on track at the moment to meet our yearly target for new housing as set out in the Housing for All plan this year. So we had about 20,000 units, so both houses and apartments, completed last year. And we'd expect that somewhere in that region is where we're going to land this year as well, maybe a bit above. That's fine for the moment, and that would keep us on track for those targets. But to keep in line for future targets, new dwelling completions would need to increase from about that 20,400 last year to an average of about 33,000 per year over the next 10 years. And that's where the uncertainty comes in, if housing delivery will be able to meet those targets as they start to ramp up. And again, that's just as I mentioned, because the construction sector has limited capacity and it's already dealing with those dual pressures in terms of labour and cost prices. In terms of what the composition of that housing looks like that we're seeing in these completions, new dwellings are increasingly apartments. They make up a higher share relative to houses of the completions. And then they're also increasingly located in urban areas. And that's reflecting what you'd expect in terms of an ongoing trend towards increased density in Ireland's cities and towns. But within that, what we're seeing is about 70% of all new apartments built last year were located in Dublin. So while home construction and apartment construction is ongoing around the country, we're still seeing a top-heavy level of building with a lot of new builds concentrated in Dublin. The last thing I'll say on the housing cost side of things is just that house prices and rents are both continuing to increase around the country. That's not really news, but within that, what we're seeing is that there's more of a trend outside of Dublin. We're starting to see both rents and house prices outstrip Dublin in those towns and cities outside of the capital. How this all kind of ties in terms of inflation is that while rising energy and commodity prices are the leading cause of inflation globally, housing continues to be one of the main domestic drivers of inflation, and by extension, it's one of the components of inflation that domestic policy can directly affect. So where we are now in terms of costs is the residential property price index has house prices nationally growing at about 15% year on year at the moment. The trend that we had seen from about mid-2020 is continuing in that those costs are increasing faster outside of Dublin than they would be within Dublin. So prices in the rest of the country are increasing at about 70% annually when you compare it to the 15% national figure, and that's just the lower Dublin growth rate pulling that down. In terms of renters and rent costs, the Rental Tenancy Board keeps a running index of rents across the country, and we're seeing a similar trend to the house prices piece in that we have annual rental growth of 2% in Dublin, and then you compare that to a 4.5% increase in rents nationally. So again, we're just starting to see those pressures mount outside of Dublin, and those growth rates outstrip the Dublin piece, which would have been out in front for many years. So overall, that's a broad overview of the Q1 outlook. If you have any questions, maybe to put them into the chat bar at the moment. I know Fergal, Jerry, and myself would be very happy to take them. So happy to take any questions and answers if you have them at the moment.
Great. Thanks, Hazel, and thanks, Ger. And look, some super insights and data observations in there. So again, please, for anyone who does want to pose any questions, please do so in the chat, and we'll come to them. Ger, I just might kick off with you, and there's a couple of things on the labour market, Hazel, as well. I'd kind of like to come back to you on. Ger, on the sentiment data, so clear observations now, right, that it looks like we're losing a bit of momentum, right? Albeit, coming into the year in great shape, still looking at very high growth numbers. Are we seeing anything in terms of actual data yet? So in terms of those kind of the high frequency data, are we seeing anything yet kind of now at the end of April to suggest that the inflationary pressures and the sentiment shock of the last couple of months is beginning to have an impact?
Not yet. I think there's a dynamic as well where a lot of the high frequency data, I suppose, on credit and debit card spending it shows both the value and the volume, right? So where you're seeing inflationary pressures, people might be buying less, but they're paying more for it. So you don't see the inflation dynamic. And on retail sales and other elements, we're still seeing very strong numbers, but definitely in the forward-looking sentiment pieces, we're starting to see that drop off pretty quickly. So you could probably expect to see them, if we are going to see them, over the kind of April, May, June The other element of it as well is that households really, in terms of the inflationary pressures that were there in March, and we saw high inflationary numbers already in March, but the probably worst of it is yet to come in terms of those pressures, particularly energy bills. They're only going to start seeing them, well, I suppose this month and into the coming months. So I think it's when we start to see those bills hit that you'll start to see the realization in households. Partly as well, households are going to be protected somewhat by the €200 government utility bill. So I think the impact of this will probably gradually come in over the next couple of months and probably hit more extremely towards the middle of the year, which is bad timing for lots of sectors. But short answer, we haven't seen it yet, but we've definitely seen it in sentiment, and there are reasons to expect it probably won't come true for a little while yet.
Government's obviously done a fair bit as well, right? You know, you mentioned the €200, but in terms of some of the tax measures and other supports, any sense at this stage as a percentage, you know, kind of proportion of the inflation increase, how much has government offset with those measures?
So if you look at what government's done, they've spent about $1 billion so far on new measures since Christmas. So they had spent $1 billion, or at least they're selling $1 billion of the previous budget as having been an inflationary or an anti-inflation measures. But in reality, new measures since Christmas is about €1 billion. If you look from a household point of view, the VAT cut is probably the one that stands out for a lot of people, plus the fuel excise pieces. Fuel excise, those cuts probably cut about half a point off inflation. And where we see VAT happening, I suppose VAT bills have gone up, or if you assume they're going to go up through the period of the rest of the year by about 25-30%, right? It effectively is handing back the increased VAT the government would have got on that 25-30% back to the household, plus a little subsidy, a pretty small subsidy, maybe 5-6% of their bill. So it's actually a good example of how the government, no matter what they do, can't do enough. They've spent €1 billion, and most households, bar the €200 grant, they won't feel it after April or the next upcoming bill, or their most recent bill, where we're starting to see that €200 come through on VAT and excise. You've probably taken about a percentage point off inflation. If you look across Europe at the moment, Ireland's inflation rate in March is still pretty low relative to other countries. In Germany, we saw 8%. In Spain and the Netherlands, they saw 10%. And in some of the Eastern European countries, they're seeing 15% inflation or in that range. So Ireland, it feels really bad at 6.5%, but we are not anywhere near the front line of this yet. In terms of the levels of inflation coming through, but government is doing some. The challenge for them is if they do too much, it makes things worse. If they do too little, obviously politically, it's really, really difficult.
Yeah. No, thanks, Joe. Probably goes to Sharon's question there in relation to our relative competitiveness impact. To date, it looks like we're doing better than others, right? The real test is going to be what the policy response is. Good morning, good afternoon, Danny. Do you want to come in on the conversation at this stage?
Yeah, thanks very much. Mine's only an observation of not knowing what's going on. I think one of the most remarkable things is the 2.5 million people employed and 2.6 million in the labour force. That's absolutely huge, of a number coming kind of out of nowhere. And the interesting thing, I suppose, just as a speculation for everybody, is we've also had the census 2 weekends ago. I mean, if 2.6 million people are in the labour force and the population is, in inverted commas, only 5 million, this is a remarkable amount of people from the population working, when you consider there must be 1 million to 1.5 million between children and pensioners knocking around the place. So it's an absolutely huge participation rate. So two things could be going on. One, there might be way more than 5 million of us knocking around, is one way to read it. Or else there's an awful lot of people who aren't actually living in Ireland, in the Republic of Ireland, in our employment numbers. They could be in Northern Ireland, or they might be in the phenomenon of outside the country and kind of phoning it in, so to speak. So there's something really, really interesting going on in those numbers. I have no idea, but it does suggest a big question mark as to what's happening. Population's either way bigger than we think, or people aren't actually living where they're working, which might be the new normal.
A lot of pieces to bring together, as you said, particularly with the census. Hazel, you observed on the increase in the female participation rate, which is again one of the great positives of the last couple of years, and you provided some insights as to why that is, partly kind of COVID and ways of working. In terms of the upside, maybe to Danny's point as well, how do we compare now to kind of, again, that Northern European kind of average, I suppose, that we would have pointed to over the last number of years, and we would have been identifying Ireland as being quite a bit behind? Is there still much more upside from a female labour market participation perspective to get us to that kind of Northern European kind of norm?
Yeah, well, I suppose at the 60% participation rate we're at the moment, it puts us over the average for the EU as a whole. That's obviously including Central and Eastern Europe that would have had lower participation rates. It's pulling us closer in line with Western Europe, but we probably do have a ways to go before we would maybe say that we're in a comparable position to, say, the likes of Sweden and Denmark. They'd be closer up to around the kind of 70% range. On the other hand, given that it's about a 4 percentage point increase in 2 years, that's quite a gain to be made, particularly given the couple of years that it's been. And I suppose there's nothing to say that we can't build on that over the next couple of years as well.
And again, the other key observation, the Great Resignation, definitely a phenomenon in the US, absolutely US business. We were there last month, spoke about it at length, and very much a constraining factor. Doesn't seem to be a phenomenon in Ireland. Lots of churn, lots of movement, and a really hot labour market. But it's great to see those aggregate numbers still coming through so strongly, which I think is really important. Some of the questions in the chat bar, maybe Eileen O'Riordan's question there in the first case, which is really, I suppose, the question is your what is inflation going to mean in terms of wage expectations? How can we build in some type of an anchoring into the wage trends that we're now seeing? Maybe, Ger, if you want to talk maybe a little bit about medium-term expectations for inflation, to what degree are we looking at kind of exceptional potential one-off phenomena kind of impacting on our inflation numbers at the moment? And also, I suppose, and again, you touched on it in your media commentary yesterday, the role that government can play here, again, around supporting some of those anchoring efforts through a much better coordination across the labour market issues.
Yeah, so it's a tricky one at the moment, in that it's worth looking back. In the last decade, we've seen fairly strong wage growth on the back of almost no inflation, right? So if you take the long-term view, we've seen real wages and real incomes grow very, very quickly in the last, or at least since 2012, and that period since we've recovered from the financial crisis. This is the first time since 1983-84, the Labour Fine Gael government, that we don't have a national pay agreement, and we do have inflation. So it's a completely new environment for almost everyone on this call, in that you don't have the kind of social partnership mechanism of pay agreements, but that kind of set norms. But you do have high inflation, and we haven't seen it in pay agreements yet come out of it. If you look at a local level, we have seen that kind of 3.5% range hold, but there's obviously going to be upward pressure the more expectations are built in about this becoming a long-term thing. I think up until recent weeks, and up until very recent weeks, there was an expectation that this would be a temporary phenomenon and it would go away quite quickly. I think the Russian invasion of Ukraine and what has happened since has meant that this is probably going to be a bit longer. Where we're guiding, we're saying, look, 6% this year, 6.5%, coming down to maybe 4% or a little bit lower than it next year. So coming into a more normal range, and then normalizing out over time. But a lot depends on the developments in Ukraine. And then on top of that, if you look at the European Central Bank at the moment, their expectation was that this all goes away in terms of level growth by next year. Now they're going to come out with new forecasts that say, it's a little higher next year than we expected, and it goes away by 2024. So I guess there's a dynamic. I guess the answer to what's acceptable depends on the organization itself, but there is an importance here as a business community that we don't build in expectations that businesses can cover the full cost of inflation, and particularly temporary inflation. Three ways that we try and do that. One is that you look at the longer term view of this. This is a 10-year time frame where you've looked over a long time, and real wages have continued to grow very quickly ahead of inflation for a long time. Two is that, look, there can't be an expectation that businesses do everything. There has to be an expectation on other players as well, and there will be periods in time where real incomes fall. And thirdly is this idea of intensified work at that Labour Employer Economic Forum. I showed that slide about all the employment costs coming down the line from this government. You would have seen it at the Taoiseach's speech at the Ibec. At the Ibec dinner last year, where he laid out all these new measures being brought forward by government, will add something like 2.5% to the cost of employing someone in Ireland in the next couple of years, and something like 10% to the cost of employing someone in Ireland over the next decade. And there needs to be better coordination of those issues. And particularly, while a lot of them might have merit, there needs to be timing coordination on them. And there needs to be better coordination of where we're targeting some of the fiscal measures, where we have that capacity to help households. And then, look, employers will have to bring something to the table as well in all of that. But that coordination is hugely important, because at the moment, or at least pre this recent bout of inflation, it's kind of come from everywhere in the labour market, on the regulation end, and that needs to be coordinated much better. So I think there's probably three areas in that we can look at. But there is no doubt that there is going to be further pressures coming down the line, the longer the inflationary period goes on. And look, no one on this call can answer that question. In that, look, it all depends on what happens in Ukraine over the next while, and in the war.
And just to say for members as well that work through the Labour Employer Economic Forum is intensifying in recent weeks and months as a result of these kind of renewed economic pressures for the economy. But it is frustrating to see that, again, government isn't getting bang for buck on its own money in terms of the supports it's already given to households. That's not been factored into a kind of wider conversation around expectations and wage anchoring. And then also the issue that we've raised in relation to the other costs of employment, that they're being taken in this kind of piecemeal manner, which is really quite frustrating, and in the aggregate will prove costly for employers. But again, it's not been part of that kind of coordinated effort to manage the overall labour cost and competitiveness of the economy. And Raphael, thanks for those comments on both. Absolutely very conscious of that, and we have been pointing out, in particularly around the statutory sick pay measures, that the cost that they're going to bring, and again urging government to do that in a much more coordinated way. Ger, just maybe a further question around interest rates, typically following inflation, right? And we're already seeing those signals from the ECB and again in recent days. So clearly preparing the ground at this stage. Could you give maybe a macro view? How material are they going to be for the Irish economy in terms of, again, the scale, I suppose, and pace of debt repayment that we've seen over the last number of years? And again, you know, we really have had an incredibly buoyant economy now for 6-7 years, right? So the deleveraging has happened at pace. Both households and business are now in a much stronger position in terms of debt liabilities. How material are interest rates going to be? If you know, can I take it from a consumer perspective? Take the pot of consumer spending. What might the likelihood be in terms of consumer implication of interest rate increases over the next 2 years or so?
So it's another area where we've gone the best part of a decade without having to experience positive interest rates. So we've had negative interest rates for over 6 years now, and low interest rates for most of the period since the ECB made a major policy error. If people remember, back in 2011, it hiked interest rates just as the Greek crisis and the possible breakup of the Eurozone was happening, and then had to reverse out of that really, really quickly. There is a danger in my mind that the ECB, if they go too quickly, jump too quickly, and they seem to be moving now in that direction, if they go too quick, too fast, they could trigger a worse economic outcome in terms of interest rates. The expectation in the market seems to be, at the moment, we're in negative territory. That will be probably 1.5% or somewhere up in that range by the end of this year or into early next year in terms of that ECB base rate. And then add that on to whatever the interest rate you're paying right now is as a consumer or as a business, right? And that has a material effect, a really material effect on outcomes in. Look, we see as Hazel talked about, the housing market very much impacted by inflation or interest rates, investment cycles, and we're already seeing some of that. Those investment decisions at a global level being made with interest rates in mind and the increase in interest rates. So things are going to change pretty quickly. And the ECB, I suppose, is different than the Fed in the US, where the Fed in the US is a dual mandate, where it has to look at the economy, unemployment and inflation together. The ECB's only job is to keep inflation at or below 2%. That's its only role, and it has no. If it has to hurt the economy to do that, then it has to be done under the European rules. So there is going to be a challenge there for them to get that timing right. And look, I can't tell anyone what the right answer is. I don't have it, and it's going to be a really difficult one for them to get the right answer to as well. But that over the next year is going to be something to watch really closely, because if they get it wrong, it could cause big problems. And the same with the Fed in the US. If the Fed in the US gets it wrong, we could have a similar dynamic in the US. So when we talk about our balancing act, that is probably one of the key pieces of the balancing act for this year. But the worry is that they go too quick, too fast, and tip us into a recession, because interest rates and rising interest rates aren't designed to hit energy costs. They're designed to hit other areas of economic activity to lower inflation in those spaces so that you can facilitate higher energy costs.
So on that question of the timing of recession, we're not calling recession. It still looks like strong momentum coming through despite these headwinds. And I think that point in terms of what sort of monetary policy we're going to see from ECB, Ireland versus Eurozone definitely could be fragile. I think Ireland, again, we could find ourselves actually in a space where monetary policy may not be tight enough from an Irish economy perspective, because given the buoyancy that we've had now for a number of years, I think we're going to see Eurozone economy fairly vulnerable to interest rate increases. I think the Irish economy much more resilient. And we could actually be looking at that kind of mismatch again between monetary and kind of fiscal policy from an Irish economic perspective.
And it's a dynamic as well, Fergal, where all these costs coming through, you'll see high turnover growth in the economy continuing. Like there's still a very strong economy underneath all of this, driving really well. Even on the consumer side, there is still a very strong possibility for an economy with lots of members, and there's this dynamic of between households and different members. Some households doing really well, others will feel this inflationary pressure more, and the same with businesses. Some businesses will continue to do well, and others will have their margins squeezed quite tightly by this inflationary pressure. And we're conscious, when we talk across membership, there's a big gap between people who are, very exposed to the energy shock, very exposed to the labour market, and people who have been dealing with a tight labour market for a long time and not as exposed to the energy shock or at the other end of that supply chain. So there's going to be a lot of different dynamics across the business sector next year, where some might feel like it's a recession even when it isn't at a macroeconomic level.
Maybe as we head towards a wrap with you, Hazel, maybe for the last question there around kind of climate change costs. You were reflecting on the inflationary pressures coming across construction, where I suspect we're going to see a lot of that come through in terms of the cost of delivering those investment measures that we know we need from both a business and a household perspective to address the climate challenge. We obviously have carbon tax coming through as well in terms of inflation pressure for business. But Hazel, any kind of observations in terms of a guide for business in terms of climate change cost and how that's going to feed through in terms of some of the cost of doing business issues?
Yeah, well, I suppose firstly on the construction side of things. So the climate change agenda obviously requires an awful lot of investment, and in particular in infrastructure, and that's both on the public and private side. The problem we're seeing at the moment coming through in those construction pressures is that, as I mentioned, from the labour and the inputs, there are cost pressures in all directions. And I suppose the risk there is that those larger projects, actually, sorry, right down to the level of maybe some of the retrofitting projects for households even, so across the spectrum of project size, you're starting to see those costs feed through. And again, that's likely to have an effect both on the cost of bringing about some of those measures for climate change, but also just on the delivery timelines and the capacity of our construction sector to meet those demands, but both for businesses and households that are, say, retrofitting or making those investments. It's hard to say exactly where that's going because, like everything, it's driven by such volatility at the moment that it's really hard to make a call about where that's going to be over the next couple of years. But it's definitely already feeding through.
It is, and some of those numbers that you showed, they're probably averaging, and again, I don't know if you've seen an industry-wide index on this, but it looks like we could be averaging in the range of 20% plus at the moment in terms of those average construction cost inflation pressures, which I think will have a significant impact in terms of what can be delivered, but crucially as well in terms of how government is now going to engage with industry to make sure that the National Development Plan in particular can be viable for contractors in terms of getting involved in the opportunities that are there. So there's going to have to be a pragmatic solution again from a policy perspective to address that issue. Okay, look, we're probably coming towards the end of the hour, so we'll leave it there in terms of questions. Just to thank everyone for joining us. We will circulate the slides again immediately after the briefing, and just to say to people, if you have any questions, comments, observations at all on any of this, please do come back to Hazel, Jar, and myself, and be delighted to engage with you and share any more data or observations we have. Okay, thanks everyone again. Appreciate your time today. Bye bye. Cheers.